This is one of the harshest tax traps affecting Australians who move overseas. You can live in the Australian home you own for 10 years, rent it out for just a few years while you're overseas, and if the property is sold while you are a non-resident, the entire capital gain on your home can become taxable. No main residence exemption, no 6-year rule, no partial discount on most of the gain. If you own a principal residence in Australia, are thinking about moving or retiring overseas, or are already living abroad, understanding this trap could literally save you hundreds of thousands of dollars in tax. In this video, I'll walk you through a real-life example to show how this trap works, why it happens, and the only practical way to avoid it, along with a few limited exceptions that may help reduce the tax impact. Let's get into it. Most Australians know that a capital gain made on the sale of their main residence is exempt from capital gains tax. And even if the owner moves out and rents the property, the 6-year absence rule usually allows the main resident exemption to continue. If you need a refresher on these rules, I'll have a video that goes into more detail. However, this protection from capital gains tax stops completely if the sale contract is signed while the owner is a non-resident for Australian tax purposes. This is where arguably one of the most insidious and expensive financial traps begins. Meet Frank. Frank signed a contract to buy a house in Sydney on 15th of December 2012 for $1 million. The property settled 6 weeks later, and Frank moved in straight away. He lived in the home for the next 7 years. On 26th of January 2020, Frank moved overseas and began to rent out the house. At the time, he expected to return to Australia after the work opportunity and some traveling. As time went on, Frank met a partner, settled into the new lifestyle, and no longer plans to return to Australia. After many years living overseas, Frank was a foreign tax resident. Fast forward to this year, Frank's tenant in Sydney moved out, and he decided it was the right time to sell the property and use the proceeds to buy a home overseas. He signed the sale contract on 1st of December 2025 for $2.5 million. Like many Australians, Frank assumed he was eligible for the main residence CGT exemption and that the 6-year absence rule covered him right up until the sales date, meaning no capital gains tax. His jaw hit the floor when he received a tax bill of over $465,000 from the ATO. What makes the reality very different from Frank's assumption is one key fact. At the time the sale contract was signed, he was a non-resident for tax purposes. On 12th of December 2019, the government passed amendments to the law for the capital gains tax main resident exemption for foreign residents. For disposal of property that occurs from 1st of July 2020, foreign residents will no longer be entitled to the exemption unless certain very undesirable life events occur, which I'll touch on later. Let's connect the dots between this change in the law and Frank's $465,000 plus tax bill. Once the sale contract is signed while being a non-resident, a whole range of concessions that are available to Australian residents fall away. There are no apportionment rules to recognize the 7 years Frank actually lived in the property. Those years are simply ignored. The 6-year absence rule does not apply either. Cost base is not reset to market value when home was first used to produce income or when the owner stops being an Australian tax resident. All of this means every dollar of gain, the full $1.5 million from the moment Frank signed the original purchase contract, is brought into the tax net. Now, Frank's example is simplified. We have assumed that his cost base is just a $1 million purchase price. But in reality, CGT calculations are far more complex. The cost base usually starts with the purchase price, then adds things like stamp duty, legal fees, buying and selling costs, and qualifying renovation expenses. From there, it's reduced by capital works deductions over the ownership period. This is a complex exercise that relies heavily on proper record keeping. However, many people never kept detailed cost-based records for their home because they assume it will always be exempt from CGT. When that assumption no longer holds, reconstructing those records can be extremely difficult. Back to Frank. So far, we know his gross capital gain is $1.5 million. A natural question at this point is, what about the 50% CGT discount once the property has been held for more than 12 months? Unfortunately, that discount is generally heavily reduced for non-residents. The calculation depends on whether the property was acquired before or after 8 May 2012. I'll link more detail in the description. In Frank's case, he acquired the property after 8 May 2012. Over his total ownership period of 4,734 days, he was an Australian tax resident for 2,598 days. That gives him a CGT discount eligibility percentage of 54.87%, which means he only receives 54.87% of the 50% discount, an effective discount of 27.43%. After applying the reduced discount, Frank's taxable capital gain comes out to be $1,088,550. There is the ATO calculator that will give you the same result. I have included the link in the description. And here is the final twist of the knife. Foreign residents pay tax at non-resident tax rates. There is no tax-free threshold. The first dollar is taxed at 30% and the rate climbs all the way to 45%. In total, Frank must pay $465,197.50 in capital gains tax to the ATO. Now, Frank's story also highlights another unexpected complication many Australians only discover after moving overseas. Life suddenly spans two countries. You are often accessing Australian websites, sensitive accounts, and local news while logging in from the other side of the world. That's where a VPN becomes genuinely helpful. That's why this video has been created in collaboration with NordVPN. A VPN stands for Virtual Private Network. NordVPN creates a secure, encrypted connection between your device and the internet. It also lets you connect through servers in different countries, so website sees a local IP address instead of your real location. With over 8,800 servers worldwide, you can choose where your connection appears to come from. For Australians living or traveling overseas, here are a few situations where NordVPN can genuinely help. Logging into Australian financial and government accounts from overseas. Using public Wi-Fi in airports, cafes, and hotels. Accessing Australian websites that behave differently overseas. And reducing the impact of location-based pricing online. One NordVPN account works on up to 10 devices and comes with a 30-day money-back guarantee. Use my link below at nordvpn.com/WealthCopilot. It gives you a great discount and 4 extra months on the 2-year plan. Thank you NordVPN for sponsoring this video. Now let's get back to Frank and the CGT trap he fell into. He can't help but wonder, if there were a time machine, is there anything he could have done differently to avoid this tax? Well, the only realistic way to avoid this tax is for him, the seller, to re-establish Australian tax residency before signing the sale contract. It is surprisingly clear-cut. As long as you are an Australian tax resident at the time you sell the property, meaning when you sign the sale contract, you can apply the main residence CGT exemption as if you never moved overseas. For Frank, if he had done so, he could have relied on the 6-year absence rule and claimed the full main residence CGT exemption, saving him over $465,000 in tax. However, one quick word of caution here. The return to Australia and re-establishment of tax residency must reflect a genuine intention to resettle. If the ATO believes the move was only a short-term tax maneuver, the general anti-avoidance rules may apply. In that case, the main resident exemption can be denied and tax benefit clawed back. Other than re-establishing tax residence, there is a small set of life events that allows non-residents to claim the main residence exemption or use the exemption as a reason to vary the capital gains withholding that would otherwise apply to your property. They apply only if the owner has been a foreign tax resident for 6 years or less, and only when something genuinely severe has occurred, such as a terminal illness affecting the owner, their spouse, or a minor child, the death of a spouse or minor child, or a forced sale following a formal relationship breakdown. These exceptions exist to avoid adding financial pressure during extreme personal hardship. But these conditions are ones most people would never want to meet, and for the majority of expats, they simply don't apply. As you can see, this trap doesn't just affect people after they have moved overseas. It also raises important questions for anyone planning to relocate. Should the home be sold before leaving? If renting it out, what is the realistic chance of returning within 6 years? If life overseas becomes permanent, how large could the future capital gains tax bill be? And what records should be kept now so the cost base doesn't turn into a headache years later? This is the area where doing your own research, seeking advice, and thinking through the long-term implications really matters. And remember, property is just one piece of the puzzle. Moving overseas also affects how you are taxed by the Australian system and how future age pension entitlements may be assessed. I have covered both topics in separate videos. Check them out if you're interested. Thanks for watching. I'll see you in another one.